everyone, good evening. You're watching The Money Show right here on ET Now. I'm Mubina Kapasi and we are kickstarting Rise with India prime time hour between 5 to 7 p.m. We have lots lined up as always on today's show as well. First up, we are going to be talking about taxation. Yes, the final date for filing your income tax return has been delayed by 1 month. So you have a comfortable 1 more month. But hey, why do you want to wait till the last minute? Like we say, don't be lax when you're taxed. So we have decided to continue with a guide on how to report various incomes. We tackled F&O and capital gains. Now let's talk about what should you do if you earn gratuity or pension. All the retirees especially should listen up and pay attention. Next, for our Meet Your Fund Manager segment, HSBC's Large Equity Fund. This is the fund that we are going to be discussing, and Tushar Pradhan, the CIO himself, will be sharing what exactly is the key theme of the fund. And finally, we have the weekend approaching, and I'm sure a lot of the investors out there may have received a ton of annual reports. But their place is not in the raddi or in the dustbin, but in your hands. Learn how to read an annual report, know how to identify the red flags, in the annual report, which may give you a sense of whether or not you should invest in the firm. A quick lesson on that is what we have lined up on The Money Show. Well, let's kickstart The Money Show with our very first topic for today, and that is taxation. Like I said, yes, the filing date has been postponed to 31st of August, but that does not mean you guys get lax. It's still important to get your work done and get it out of the way so you can once again be back to planning your finances. Today, we have decided to take on board the topic of gratuity and pension. So all those who've just retired from their jobs or for their income, listen up. This is a show that's important for you. Remember, gratuity and pension are essentially payments that the company does pay out if in case, or when rather, you leave your job or you are retiring from your job. It looks a little complicated, but this is essentially what the gratuity exemption calculation looks like. When you receive gratuity from your company, the entire amount is not exempt. There is a certain amount that's exempt, and it is the least of these three options. Whatever is the lowest is the gratuity amount that is exempt. A similar calculation is for pension funds as well, pension schemes, as well. But I think I'll take forward this conversation then with Mayur Shah, the tax head of Ernst & Young. Mayur, thank you so much for joining in on ET Now. Let's start by talking about these two sources of income, and let's first start by gratuity. It's of course received as a lump sum towards the end of your employment. Mayur, what should exactly be the reporting guidance in the income tax return when an individual receives gratuity?
Gratuity needs to be reported in the return of income as a separate item. When you go and fill up the form, there will be a drop down which will be offered, and there you can have a gratuity as another line item, and in that line item you have to report the entire gross gratuity. There would be an exemption sections where you need to just put in what part of salary which is exempt. As you rightly pointed out, the entire amount may not be exempt, but it will be the list of certain items which will be exempted. So you have to enter the exemption amount. Do not need to specify how one has calculated, and the net salary gets calculated based on that. So this is how gratuity needs to be offered to tax. There are two things one needs to understand: gratuity which is paid under Gratuity Act, and the gratuity which is being paid not under Gratuity Act but otherwise, and the calculation methods for both are different, and one needs to understand and then calculate those gratuity exemption. However, the maximum gratuity exemption one can claim in lifetime, it is not more than 20 lakhs.
In your lifetime, you cannot claim more than 20 lakhs. If you do, then that amount will be taxable. Now, this is gratuity. Let's talk about pension. For a lot of our pensioners who may be watching the show may be aware that there are two kinds of pension, Mayur. One is which you receive all together, and the other may be that the pension is received over a period of time. And Mayur, the tax obligation does differ on both of these. So how should one report commuted and uncommuted pension in the ITR?
Sure. So, the pension generally commuted or uncommuted is paid by the pension authorities or provident fund authorities, and therefore that this never reflects in Form 16. This generally being given outside the Form 16, and therefore the obligation to report is on the taxpayer to report it separately as a pension, another line item which will come out from the drop down once you start filling up the salary related information. And exemption is available for commuted value of pension, and that has to be calculated as per the provision provided under the law. If a person has received gratuity, in that case 1/3 of the commuted value of pension will be exempt from taxation. In case person has not received gratuity, then 1/2 of the commuted value of pension which will be available for exemption. So like gratuity, entire gross value of pension, commuted value of pension needs to be reported, then exemption needs to be reported, and net amount will be taxable. In case of a person is receiving on a monthly basis, the total sum which has been received for that year needs to be reported as taxable income as a separate line item.
Okay, so basically, Mayur, both gratuity as well as pension would be chargeable under the head of income from salaries. Would that be right?
That's absolutely correct.
Okay, all right. Mayur, just one more question then on pension. Like you mentioned, it will not reflect in the Form 16, but by the pension authorities who will deduct tax. So, Mayur, are we looking basically that this pension amount which the individual will receive will be reflected in the Form 26 AS, and it will also show that, the authority has deducted TDS. Will it reflect in Form 26 AS?
That will reflect in 1026 AS, as the authority also required to submit TDS return or tax withholding return, and based on that 26 AS will reflect those pension payments as well as TDS thereon, if any. If there are no TDS, then it will not appear in 26 AS.
Case, Mayur, assuming that the pension authorities will obviously know the portion that is exempt and that's not exempt, would it be safe to assume that we can directly, believe that whatever pension income the individual is receiving, the pension authorities will have duly deducted tax, and hence the individual does not need to worry about having more tax payable? Would that be correct to assume?
That is correct to assume.
Okay, all right. So I guess the entire procedure would be quite simple if you guys do have pension income. Folks, we're going to keep our phone lines open now. Any kind of questions? Okay, Subhash Chandra Garg is talking right now. Please, let's just cut across that. Hi, sir. So just
I don't think I should speak.
No, you should speak today.
Sir,
Like, at
couple
least,
of lines,
what is your
on-
biggest achievement like in this ministry?
No
now?
achievement.
Or any regret you have
No
on the
regrets.
sovereign bonds
No, nothing. Sovereign bonds.
Sir, one more thing, one important thing. So, there is this news of your voluntary retirement. Let's frame the question. Active service. We look upon it as a very bold step. Anything that you would like to add on that, sir?
No, only the fact of it. That's it.
So you are happy?
Of course,
What is the promotion?
You are going to take the charge of power ministry?
tomorrow, 10 o'clock.
Okay.
Yeah.
And the decision on VRS is also well thought out, sir. You're given time to the government to think
Everything is well thought out.
You're given time to the government to think over your decision, sir.
No, I am required to give 3 months notice. So I have given 3 months notice, right? Okay.
Thank you so much, sir. Thank you.
very few words with the reporters, but that of course was the Economic Affairs Secretary, who had overnight in a reshuffle been moved to the Power Ministry, and now Subhash Chandra Garg has given his 3 months notice to the government for early retirement. I suppose last few words that we will be listening to him from him in his capacity. Okay, let's get back to the Money Show, and as I was saying, our phone lines are open. We're kickstarting Ask the Money Show. So if you have any questions or queries, especially on income tax, especially on pension and gratuity, whether it's for yourself, your father, your mother, you can get your questions answered by Mayur Shah himself. Your golden opportunity, like I always say, to get it answered by an tax expert of the Big Four. 24990388 is where you can call in, or you can also, of course, email us on the Money Show at etnow.tv. Calls are preferred. Let's first bring on board our question from Vinay Pahar. He says, I retired last year in December. I am eligible to receive gratuity and pension. Now my company is asking me if I would like my pension all at once or over a period of time. What would be a more tax efficient option? He is basically referring to commuted pension and uncommuted pension. Like I said, receiving something all at once, that's uncommuted, and receiving it over a period of time is commuted. So Mayur, how would you help Vinay out with his query?
See, since he is receiving gratuity, the only what exemption is available for commuted value of pension is only 1/3 of the pension, which can be claimed as an exempt. And once he has retired, his net taxable income will go substantially down over a period of time. He should choose part of the pension should be commuted, and balance should be received on a monthly basis, so as to have a more tax efficient way of drawing pension.
Okay, so that's the recommendation. This would be the most tax efficient option. Like I said, you can quickly call in and get your questions and queries answered by Mayur Shah of Ernst & Young. Okay, Mr. P. Bajaj has sent a question. He says, I have read about pre-filled ITRs or income tax returns. How is one to procure that? Also, do these ITRs automatically calculate the non-exempt and tax-free portion of the gratuity income? For pension, like we just flagged off earlier, you can simply take your form 26AS and see what sort of TDS has been deducted by the PF, and you can, accordingly fill your income tax return. But for gratuity, how does it work? Let's go across then to Mayur. And Mayur, he's asking whether in the gratuity case as well, the income tax return will automatically calculate how much would be exempt. Would that be the case?
So the pre-filled return, the way it happens is that whatever your employer has submitted as tax, gross gratuity and exemption that they have calculated, they would be submitting the same information under TDS return, and based on that, the return pre-filled return comes out following certain processes, and therefore there is no need to calculate separately. It happens automatically by then.
Okay, so these pre-filled ITRs obviously do make your life very simple, but do remember they depend on the information that has been given by your employer or your financial institution or your bank where you've invested money. So if your employer has reported the gratuity portion and said that this much is exempt and this much is what I am deducting tax on, then that's exactly what will reflect on your income tax return. Certainly pre-filled ITRs have made our lives very, very simple. Okay, we have Ferial Fosdar who has sent in a question. Ferial asks, do I have to separately show my salary income and gratuity income in the IT or income tax form? The form 16 I have received from my employer shows the total amount I have received as full and final settlement. How should I report this? No separate bifurcation of what's the salary portion and what's of course the gratuity portion. In such a scenario, then Mayur, how should Ferial go? Maybe one could assume that Ferial is working with perhaps a semi-organized firm, and that's the reason why perhaps the form is not complete or her salary statement is not complete. So how would you advise her to go about this?
See, in such a situation, he has two options. Either go back to the employer and say that I need to submit this return where breakup is required, and he should obtain those breakup from the employer and fill the return. Alternatively, he can currently submit this information in the form and manner it is available with him, and request employer to resubmit his TDS return so as to reflect the right values and what is taxable and non-taxable, because reporting a requirement is on the taxpayer. Correct information needs to be disclosed by the correct taxpayer. Non-disclosure could result into penalty consequences. So one should try and make sure that they receive correct information. In the scenario where they are unable to obtain, even tax authority do consider before levying any penalty, and therefore he should make a return request to the employer so as to safeguard himself from any consequences arising on account of not disclosing appropriate information.
All right, so that is of course Mayur's recommendation. You'll have to go back to your employer and talk to him or her about getting this your total income component separately as salary and gratuity, because in the income tax return form as well, you do have salary that has to be reported separately and gratuity that has to be reported separately. So this is a requirement. You'll have to go back to your employer and talk to him or her about the same. And we have Mr. P. Bobby who has sent in a question. He says, do I have to audit in case of F&O trading loss? Okay, this is not pension or gratuity, it's F&O trading, which is always a bit of a tricky question. He wants to know, can the loss be carried over if it's not audited? And also, how is turnover, I'm assuming F&O business turnover, arrived at? Okay, Mayur, how would you help him out?
Yeah. So, there are multiple methods in which income from F&O is to be offered to tax. Assuming that, the person has not opted for presumptive taxation, in that case, and generally in case of loss, people do not offer it under presumptive taxation, and has not offered under presumptive taxation in past. In that cases, if gross receipt or turnover is above 1 crore, in that situation, the accounts are mandatorily required to be maintained and audited. But if gross turnover is less than 1 crore, then one is not required to maintain or get accounts audited mandatorily. To claim a loss, the audit is there or not is irrelevant so far as his turnover is less than 1 crore. And loss which cannot be set off can be carried forward for next 8 years to set off against a similar gain or a business. And there is there is nothing which says that to carry forward loss one has to get accounts audited. Now the third question which was there, that how do one arrive at turnover? The turnover is arrived based on the difference between the sale and purchase or purchase and sale, or any premium which has been received for F&O transactions. So it will be a total of all this will make a total turnover for that year, and this is how one calculates turnover to determine whether tax audit is applicable or not applicable.
Okay. All right, I hope with that we've been able to answer all questions and queries, but we are out of time. So Mayur, thank you then for joining in on the Money Show and helping our viewers out with all their questions and queries. Yes, there are approximately now 35 odd days to go to file your income tax returns, but that does not mean you get lax. You will still have to be prepared in terms of filing your return. It's important to get that done, and hence we at ET Now have decided to give you a step-by-step guide on how you can file your return for the simplest sources of income: salary, interest income, and if you are paying an EMI on house property. You will have to fill the income tax return 1. Take a look at how you can do so. First, a little homework. Ensure that you have with you the Form 16 from your employer, the Form 16A from your bank or any other institution where you have savings or fixed deposits or any other kind of deposits, and also make sure that the figures given in these forms tally with the Form 26AS. You can get the Form 26AS from the Traces website. And now, let's begin. First, log on to incometaxindia.efiling.gov.in. If you are a new user, click on Register yourself and follow the instructions. Ensure all details match your PAN card. Else, select Login here. This page is the dashboard. Hover over e-file and select Income Tax Return in the drop-down. You will find your PAN card details pre-filled. Since we are filing our return for the year ended 31st March 2019, the assessment year or the AY will be 2019-2020. I know it sounds odd, but the assessment year is always 1 year ahead of the year for which you're actually filing your return. Select the ITR, which in our example of a salaried individual not being a director in a company will be ITR 1. For submission mode, select Submit Online. It's the easiest and fastest. Of course, for submitting online, you need to have an Aadhaar card and the same needs to be linked to your PAN card, which is now of course compulsory. This will bring you to the first page, the instruction page of the income tax return. You'll notice multiple tabs on the top. Consider them as the pages of the form. Click on the right arrow at the bottom. You'll notice all your personal details are pre-filled here, right from your name to your address. Verify all these details once and make the necessary rectifications. The next page is a computation of income and tax page. Basically, a synopsis of all the income you've earned during the year, the tax on the same, the TDS deducted, and any tax, advance tax or self-assessment tax paid by you. Let's start with salary. Here, if it's not already filled, enter the salary as per your Form 16 and Form 26AS. The deduction section will be pre-filled because, well, they're fixed and decided by the government. Next, house property. In our example of a home bought on loan, one must select self-occupied. And don't forget to enter the interest paid on the EMI as you enjoy a tax benefit. Oh, also, don't forget to frequently save your work. Next comes income from other sources. Basically, interest on savings accounts and fixed deposits. Coming now to tax deductions. Here is where you fill in school fees, provident fund, insurance premiums, and finally, the total tax payable by you is computed automatically by the system. Click Next. All the tax paid to the government by your employer and your bank or institution will populate here. Click Next. And finally, this page gives you a preview of the tax payable by you and that what's actually paid and what's the refund that you will finally receive. Also ensure you update the department about all the bank accounts held during the year. Finally, digitally sign off the return. Ensure you click on e-verification of the return. Like I said, easiest and fastest. Press preview and submit. Give everything one last glance and then finally confirm the return. Select e-verify via Aadhaar, enter the OTP and you're done. No need for printouts and paperwork anymore. Right from acknowledgements to the entire form, everything is saved historically, that is, right here on the income tax website's dashboard. No need for paperwork and no need to sit and call your CA or any other friend that could help you out with the ITR. I hope this step-by-step guide has helped you with that. Coming up next is Meet Your Fund Manager for the HSBC Large Cap Equity Fund. Hi everyone, welcome back. You're watching The Money Show right here on ET Now, and now I have Karunya Rao as well joining me right here on the show as promised. It's the Meet Your Fund Manager segment where we discuss funds that are owned by, of course, all our viewers. And Karunya, which fund have you selected today?
Well, today HSBC AMC is on our radar and we've picked out the large cap equity fund that HSBC is managing. So let me get you some more details, Mubina, if you allow me to. Well, this is what it looks like. This is the kind of exposure or rather on the riskometer how it features. It's moderately high risk, even though it's called a large cap fund, and you know how index stocks are supposed to provide you more comfort and more stability. This one is featuring slightly high on its risk radar. It's moderately high. Let me talk about the returns that it has yielded over the last couple of periodic intervals. For the last 1 year, it's a little over 4.5%. For 3 years, it's been 11%. 5-year period, the yield has been of almost 9%. That's the kind of performance it has shown over the last 5 odd years. 1 year interval, 3 years, and 11 years. 3 years. Definitely, you've seen how immensely it has yielded 11%. What are the kind of stocks that feature on the large cap equity fund run and managed by HSBC? HDFC Bank, the highest exposure they have, 9.8%. HDFC 9.6%. ICICI Bank 9.4%. So within the large cap universe, it is the private banking lenders. Clearly, you can see the private lenders which feature on top of its list, followed by the likes of RIL, Kotak Mahindra. There's again an Axis Bank with 5.9% exposure. Infosys 5.9% again there. There's L&T a little over 5% as well. There's TCS 4.9%. SBI with 4.73%. Next, what are the sectors that they are betting on, or what are the sectors which comprises of a large chunk within their fund? Banking features on the top of the list with 36.4%. Software is the next one with 13%. There's financial with 12.2%. There's petrol names as well, which have about 8.2%. There's consumer non-durables 5.4%, and of course a whole other host of sectors and industries which they are also betting on, which make up for nearly 25% of their portfolio. Well, there you have it. We saw a good look at what the large cap equity fund looks like. Let's get in some more perspective, some more deep dive analysis and insight into the fund as well. Let's welcome in Mr. Tushar Pradhan, the CIO of HSBC Asset Management, to talk a bit more about it. Mr. Pradhan, thank you so much for taking time out for our special segment on the Money Show. Just want to start by asking you about the basic theme of this particular fund. What are the triggers? What are the sort of overarching idea that was behind it?
I think, as the name suggests, HSBC Large Cap is a blue chip fund. It concentrates on the biggest and the best companies in this country today. And as a large cap fund is, again, according to this categorization, concentrates on the largest market cap companies in the country today. It is again a very good entry point for most investors to say start investing into the largest and the biggest in the country.
So the beta of the fund is more than one. Not a fund for investors who may want to play it a little safe, is it?
Well, beta is one aspect of risk. There are other aspects such as standard deviation, for example. The standard deviation of this fund is right now about 13% versus the index standard deviation about 15%, which means it's slightly lesser risk by volatility. We also have another measure called tracking error, which means that it comes close to the index. And here the tracking error is just about 2, which means it's almost similar to where the index will likely be. So from a risk perspective, from how an investor would look at it, I think beta would just be one of those aspects. And the beta is of course 1.01, which is not really again very high.
Right. Many of the names which we just saw, which are part of the funds, they seem to be of a pretty high valuation. Can you give us a rationale of what made you bet on these names?
Yeah, that's a very interesting question, because at the moment what we have is a very large two-tier sort of market where people are gravitating towards more expensive companies because they provide a very high level of profitability and a lot of certainty in terms of this earnings coming. And there is a lot of uncertainty around some other parts of the market where there is very large cheapness, if you want to say that word. Now, if you go to the cheaper companies, you are definitely guaranteed lower earnings growth.
Right.
So you have to have a little bit of a balance. So it's not as if all of our companies are expensive. And of course, the fact that it is a large cap universe, so it is limited to the top 100 companies in this country anyway, which means we have to have a balancing act between something which we continue to feel will be robust from a profitability perspective, and we will give that in turn or in exchange for some companies which are also cheaper. So it's basically a diversified set of companies where some companies clearly are more expensive than others, but I think we believe that the profitability in those companies will drive our aim to make sure that they continue to be robust.
Right. So if we were to look at the entire fund, which we did give a peek of to our viewers as well, as a leaving message, as a closing note, what would you like to say to your stakeholders? What would be your message even to the prospective unit holders?
I think whenever an investor wants to look at a country as a whole, I think one should look at the leaders. Say for example, if I want to buy India, I would like to see which are the largest, biggest companies in this country. I will also like to see which are the largest market shareholders in each of their markets. And this fund or a large cap fund generically also will provide you with the best choice within that aspect. It may not be something of a growth orientation because already these companies are large enough, but they are the largest in the country. So I think it's a good first start for any investor to come in to say, well, I'm going to get invested in this market. I will start at the top. I will buy the best known companies. There will be a lot of comfort in understanding the names because there is a lot of recall in terms of, okay, I bought something which I know. And over time, they will get comfortable with the variation of the value, knowing that they have bought the best and the biggest companies in this country. So I think that's a good way to look at this fund.
Definitely, the largest of the largest names, the best of the blue chip names is what we've been seeing on your fund, and that's thank you so much for giving us an insight into what made you bet on these stocks, on these sectors that you're really bullish on.
Welcome back. You're watching The Money Show right here on ET Now. We took you through how you should report incomes in your income tax return. We took you through the HSBC Large Cap Equity Fund. And now here's another very important aspect on investment, and that is annual reports. This is the season where you will be getting a lot of annual reports from various companies that you've invested or bought equity shares of. What do you tend to usually do with your annual reports? I'm sure reading them would be something that would not be on your agenda. You'll probably just skim through it or glance through it. Well, on this edition of the show, I would like to tell you about how you can make the most use of your annual report, how to self-assess these reports to understand what to make of it and whether that company continues to be a prudent investment option for you. To help me analyze the annual reports across sectors and across companies, I will be joined by a very special guest. And I'm talking about not just your P&L and balance sheet, I'm talking about audit reports, management discussion and analysis, and even the notes to account. So let me bring on board then Chirag Jain. He's a senior fundamental analyst with Sykes and Ray. Chirag, thanks so much for joining in on The Money Show. You know, very often we have this tendency that when we get the annual report from a company, ya to raddi mein jata hai, ya it's just lying around for a very, very long time until your house help will decide to throw it in the dustbin. So firstly, explain to our viewers what exactly is this importance of this 100-page document that comes once a year.
Okay. First of all, annual report is something like, for example, if I want to decide if I have to invest in a company or not, I go through a certain documents, I get to know about the management's comment, auditor's opinion, the financial statements. So all of this data, you find it in a book called annual report. So before reading an annual report, basically what you need to know what to look for into an annual report. Unless and until you know what to look for in an annual report, it's just gonna be a chaos for you. Now, if you see, like few decades back, annual reports were nothing but a very few thin documents, you know, followed by chairman's letter. So that were
just
mostly
simple paper documents,
simple papers and all of it. But today, with all the extensive disclosures and everything, it runs into more than 200-300 pages. So now the major question, like I want to invest in a company, it's not easily answered because the annual report itself contains so much data.
Yeah. True, of course. So let's say if I am interested in a company and I manage to procure the annual report.
Yes.
If I have to identify which pages of that annual report will tell me the future story, what should I read?
So there are basically 5 important, you can see the 5 important headings in an annual report which you need to actually go through. First one is called your management's commentary. Second is your auditor's opinion. Then comes your balance sheet, profit and loss statement and cash flow statements.
But in the management commentary, I mean, let's say if it's my company, I would always like to paint a pretty picture, right, to
Yes.
prospective investors.
Yes.
So then as an investor, how can I understand what part of the management commentary to rely on and what not to?
Yes, I would say management commentary is basically done by the top management, all the CEOs, MDs and all of that. So basically
Right.
they give you a gist of what has happened in the company in the previous year. But the thing over here is they always tend to boost only positive numbers and
Yeah.
they tend to play down on the negative factors. Here you have to actually go through other datas also to critically examine whether what management has told you is painting a correct picture of the scenario or not.
Okay, let's take it one by one. You mentioned, we talked about management analysis. Now
Yes.
let's talk about balance sheet. In
Okay.
fact, here are some very interesting pointers as well about how to decode the balance sheet. One of them was current assets and current liabilities.
Yes.
If your working capital reduces suddenly.
Yes.
The other one was, of course, the higher liabilities. Let's take it one by one then.
Okay.
Importance of balance sheet. What
Okay.
numbers should pop out then in the balance sheet? Let's take that one by
Okay, so balance sheet basically it consists of assets and liabilities. Assets is what you own and liabilities is what you owe.
Oh, right.
So when you see there's two more important part of the balance sheet. One is your debt and another one is your equity. Equity is basically what is your own investment in the company and
Right.
that is what you have borrowed. If you see over a trend, a particular trend where debt is continuously increasing as a vis-a-vis your equity, that's not considered to be a good sign. So
Yeah.
one
Higher
such,
shareholders'
yes,
equity.
exactly. So higher shareholding, higher shareholders equity portion versus your liability. The company which has a higher equity holding compared to the debt holding in a company, it's perceived to be a stronger company.
Okay, from a purely balance sheet perspective, it's
Balance sheet perspective,
So if in
yes.
case you see your debt, the debt line item suddenly rising over a period of time,
Yes.
that is basically a red flag
Yes.
in the books. Okay.
Yes.
Let's also talk about the entire current assets, current liabilities. That too is a line item in the balance sheet.
Yes.
And
Yes.
sometimes these numbers as well radically tend to change.
Yes.
Should that as well be a red flag?
Yes, actually, so current assets minus current liabilities is what's called your working capital. So higher your working capital, higher is what it's saying is you are efficiently running your company.
Yeah.
If your current liability suddenly increases more than your current asset, which means then you'll tend to borrow more money from outside, which will only lead to more interest payment and lesser profits in the future years. So I would say one thing to look out for is the working capital cycle.
Yeah.
In the number of days should be a reducing cycle over a period of time, which is considered to be a very strong point over here.
So again, a trend. If there's a
trend,
stable
yes.
trend, it's
A
all
trend.
right. But if the trend radically changes, then it's a bit problematic.
It's a
Okay,
problematic.
let's talk about profit and loss. Now, this was, of course, the balance sheet, which, by the way, is a very stable statement. Let's talk about profit and loss account. Over here, very quickly, again, what should an investor or a prospective investor first look at?
So first you should look at is the sales revenue,
Yeah.
which is the major thing. So basically companies sell products or services.
Right.
Over a period of time, what you should look at it if the sales are rising or not. That is one of the healthiest indicator for any company. If sales are rising, which means the company is selling more and more
All
products.
else being equal.
Yes, actually, and the company is following a good strategy, and that's considered to be a very good positive sign of the company.
Okay, rising sales volume,
Rising
steadily
sales.
rising state.
Yes.
What else in the P&L?
What else? Other than sales, the second important factor is operating
Cost.
margin.
Yeah, margin.
Operating margin. So operating margin, your operating margin is nothing but your sales minus cost of goods sold. Cost
Okay.
of goods sold are like your raw material expenses, employee expenses, rent, etc. Operating margin should also be rising vis-a-vis your sales. If your company is reporting an increasing sales but a diluting operating margin over the year, that's just saying that the management is not working out properly or the expenses are not in control of the management, which is not a good sign.
You know, you've also mentioned here, don't see a sudden rise in profits as a positive sign. Why is
Yes.
that?
So sometimes in the operating margin, sometimes in the net profit of the company, there's other income included also. So what is other income? Basically, other income is other dividend income, interest income, etc. Or whenever a company sells a unit or something, it tends to include that part in your other income. And if you see a sudden rise in profits, and which is because of other income, it is not considered to be a good sign.
Okay, in fact, I'm going to come to the red flags as well, but before we do that, I just want to talk about cash flow.
Yes.
What we see in the profit and loss account could show a different picture as opposed to what we see in the cash flow statement.
Yes.
In fact, the cash flow could sometimes give a more verifiable picture. So do you
Yes.
believe that would be a more important statement as opposed to P&L?
Yes, I would say that. So there's a theory like net profit. You have a net profit at the end of the year, every year. But net profit is something you cannot deposit in your bank account or you can just carry and spend around on something. For that you need actual cash. So for that you need to look out the cash flow statements, because there is where you exactly come to know whether my net profits is actually turning into a positive cash flow for me.
Yeah.
And cash is what I can actually spend or deposit in a bank account
Or pay
something.
dividends.
Yeah, pay dividends. So I have to look out for the cash inflows and positive cash flows over a period of time.
Is again a positive sign.
Yes.
Okay, all right. Now, of course, the most important, and that is the red flags. This is something that everyone is worried about, because
Yes.
if a share price doesn't go higher, it's okay. But when it tanks is when, of course, it will spook a lot of investors.
Yes.
So now,
Yes.
let's talk about those red flags. I think you've shown us a couple of examples as well, and I'm going to show that right here. Could you give us some examples on what sort of red flags? Like, for example, you flagged off this one. What exactly does this mean?
So here, this is one of the footnotes of the annual report. What
This is something you have analyzed, an
Yes.
example. Okay.
So what happened over here in this company, they took a lot of borrowings.
Okay.
And so they have mentioned that, okay, we have taken a lot of borrowings. But what has happened over here, they have taken that borrowing to fund their subsidiaries.
Okay.
So that has increased. On your asset side, what has increased is loans and advances. Now, in the footnote, what they have not properly mentioned is, what they have mentioned is, we have committed to provide financial support to subsidiaries, amount not ascertainable. So
Okay.
you don't know where the money is going. They
Yeah.
just simply told you, okay, we have borrowed so much, we have put it in our company and it's gone to our subsidiaries. To whom it has gone, why it has gone, amount is not mentioned. And suddenly, after a couple of years, you come to know that money is gone.
Yeah.
So they are not accountable for that. So this is a very big red flag if you find such statements in company reports.
And this is in the notes to accounts.
It is in the notes to accounts,
That
yes.
means that tends to give you a good picture as
Yes.
well of what's happening. Okay, let's bring up the other example then that you have flagged off earlier as well. This is in the notes to accounts, how to spot the red flags. Where else? And this is the second example. This is in fact directly in the balance sheet, and we have
Yes.
two examples here. So what is it that you're observing here in an example?
So continuing the previous point over here, the company, if you see in 2017, this was
Yeah.
the borrowings. Now this is in crores, okay?
Yeah.
This was the borrowing. Borrowings, if you see, have increased 5 times. Okay, and that's the most worrying sign for the investors. Like, that's not a good sign. Okay, then I would look on the asset side. What have company added? Why have the
yeah.
company done the borrowings? What I find out that company has had no loans given, and which has suddenly increased to 3,300 crore, like from zero to almost like. So entire borrowing was for
Has
this
gone
part.
toward loan, yeah,
Yes, and
yeah.
this money has gone out to some other company. So now I'm worried if a company has taken a huge debt and the money has gone out and the company is not providing me any kind of explanation, management is not telling me what it has gone for. This is a very big red sign.
Unlike if it's gone for, let's say, a fixed asset or you know
Yeah.
something productive, it's just gone to loan, which looks like quite a there's no explanation as well given. So this as well is a
True.
red flag. And I think you have shared one more red flag, and that is, I think, for non-recurring items. We'll just bring that up as well. We'll just wait a moment till that comes up. Okay, no, this is in fact balance sheet trends, reserves and borrowings. What exactly
So
should one see
exactly
here?
in the balance sheet on your liability side, what you have earned over a period of time, the
Yeah.
profits, if you see, all of that is added to your reserves.
Yeah.
Now, if you see the spot over here, over the period of time, the reserves are actually coming down.
They're decreasing.
In fact, in the previous year, 2019 itself, the
Negative.
reserves become negative. This is a very big negative sign. But you see, the reason over here is the borrowings. The borrowings have increased tremendously, and the reserves have gone down. So this is not a good sign. I would not want to invest in such a company or look for such a company which is having a degrading or negative reserves and
Yeah.
increasing borrowing.
Okay, all right. Decreased from 39,000 crores all the way to negative 5,500
Yes.
crores. This is a very, very big red flag. And finally, of course, on one-off items, recurring items. Again, some examples on such items that you have seen, which again would catch your attention.
All right. So, for example, there's a company doing business.
Yeah.
It has a lot of units. Okay. In sudden year, it sold one of its units. Now, the what they have sold is they have actually shown as an other income as a profit. Now, when a common investor sees that, what he sees it, okay, now the profits have increased 10 times.
Yeah.
But what they fail to realize is this includes other income. That other income is a non-recurring item. It is only a one-time event. This will not come again. So that tends to show a higher profit, and media also, if you see, the profits have increased from 100 to 1000 and all
it
of that. Yeah, without actually telling you that okay, it was a part of other income which was included in the 1,000 crores. So we should look into that also, the details.
Okay, so I hope this has made all our viewers wiser there on how they can read annual reports. These are some more very interesting red flags, in fact, that are being spotted. Chirag, thanks so much then for joining in. And folks, we have a weekend coming up, so I hope you're going to make wise use of that and read all the annual reports that you have received over a period of time. With that, we will wrap it up on The Money Show. Thank you so much for watching. Hope you enjoyed this edition. We'll be back tomorrow with a brand new episode.